Michael Burry was born on June 16, 1971, in San Jose, California. He entered the world during tremendous economic optimism in America. The 70s had been turbulent with stagflation and oil crises. By the early 70s, the nation was beginning to recover. Burry's childhood unfolded in California suburbs during a time when technology was reshaping society. His parents were educated professionals who valued knowledge and independent thinking. They encouraged their children to question everything and think deeply about the world. Growing up in San Jose meant living at the epicenter of what would become Silicon Valley. The computer revolution was beginning, though most people did not yet understand its significance. Burry's family was intellectually rigorous and discussed complex ideas at the dinner table. His father was a chemical engineer and his mother was an artist. This combination of technical precision and creative thinking would later define how Burry approached problems. He was an only child for much of his early years. He spent considerable time reading and thinking alone. At age 2, Burry suffered an eye problem that required surgery. The surgery was successful, but he had to wear a thick eye patch for an extended period. This early physical difference made him acutely aware of being different from other children. He was already intellectually advanced for his age. Now he also looked different from his peers. By age 4, he was diagnosed with Asperger syndrome, though this diagnosis would not be formalized until years later. He exhibited classic traits of the condition, including intense focus on specific interests. He had difficulty with social interaction and a literal way of thinking about the world. Burry's childhood was marked by both intellectual acceleration and social isolation. He learned to read at an extraordinarily young age and consumed books voraciously. He would lose himself in subjects that interested him, reading everything he could find on particular topics. This ability to hyperfocus would become one of his greatest strengths as an investor later on. School was difficult for Burry in ways that went beyond academics. He was intellectually far ahead of his classmates but socially behind them. Other children found him strange and difficult to relate to. He did not understand social cues and often said things that seemed rude without meaning to be. Teachers recognized his intellectual abilities but were puzzled by his social struggles. He would sit in class already knowing the material and becoming bored with instruction. At the same time, he struggled to make friends and fit in with his peers. During his teenage years, Burry discovered his passion for mathematics and science. He excelled in these subjects in ways that seemed almost effortless. His mind worked in the abstract realm of numbers and theories with remarkable clarity. He could see relationships between mathematical concepts that others had to work hard to understand. Physics fascinated him because it revealed the underlying rules of how the universe worked. Burry attended Piedmont Hills High School in San Jose. He was a serious student who got excellent grades. He particularly excelled in mathematics and science classes. He was not a typical high school student in any conventional sense. While other teenagers were going to parties and dating, Burry spent his time reading about science and mathematics. He participated in the school science clubs and academic competitions. His teachers saw him as a brilliant but unusual student. They recognized that he had the intellectual capacity to do almost anything he wanted with his life. As Burry moved through high school, he became increasingly certain that he wanted to pursue science or medicine. He was fascinated by how the human body worked. The idea of becoming a doctor appealed to him. It combined science with the ability to help people. He was not motivated by money or status. Rather, he wanted to engage with complex problems and use his intellect to make a difference. Burry enrolled at UCLA to pursue a degree in pre-medicine. He was determined to become a doctor and had been working toward this goal for years. At UCLA, he continued to excel academically. He took the most difficult science courses available and performed exceptionally well in all of them. His pre-medical coursework was rigorous and demanding, but he found it stimulating rather than overwhelming. He was surrounded by other highly intelligent students for the first time in his life. Yet despite this, he still felt isolated and different in many ways. During his college years, Burry began to show signs of the eye condition that had affected him in childhood. His vision deteriorated over time. Doctors eventually diagnosed him with cone dystrophy, a rare genetic eye condition. This condition causes progressive vision loss over time. Burry was devastated by this diagnosis. His path to becoming a doctor suddenly seemed impossible. He had been working toward this single goal for most of his life. The diagnosis of cone dystrophy forced Burry to confront a fundamental question about his identity and his future. He could not simply accept the diagnosis and move on. Rather, he spent considerable time researching the condition. He read everything he could find about it. He became an expert on his own disease. He attended every specialist appointment with detailed lists of questions. He explored every possible treatment option and followed emerging research. This same hyperfocus that had served him so well academically now became focused on understanding his own medical condition. Despite the diagnosis, Burry completed his pre-medical requirements at UCLA. He graduated with honors and applied to medical schools. Several medical schools accepted him. He was admitted to programs at reputable institutions despite questions about his worsening vision. Burry chose to attend the University of Texas Medical School in Houston. He was determined to prove that his eye condition would not prevent him from becoming a doctor. He moved to Texas with a combination of determination and uncertainty. Medical school was exceptionally demanding both intellectually and physically. Burry threw himself into his studies with characteristic intensity. He spent countless hours studying medical literature and learning complex physiological concepts. His mind seemed almost perfectly suited for medical education. He could absorb information at a remarkable rate and retain it with precision. Yet as his vision continued to deteriorate, he began to face practical challenges. Reading small text and looking through microscopes became increasingly difficult. He adapted by using magnification tools and working with classmates to manage his limitations. By his third year of medical school, Burry's vision had deteriorated significantly. He could no longer see well enough to safely practice medicine. This was an extraordinarily painful realization. He had spent more than a decade working toward this one goal. Now he had to accept that it would not happen. The process of leaving medical school was difficult and emotional. He felt like he had failed, though rationally he understood that he had not failed at all. After leaving medical school, Burry faced a crisis of identity and purpose. He had spent his entire life pursuing medicine. Now that path was closed to him. He fell into a period of depression and uncertainty. He was living in Houston with no clear direction for his future. He had a strong background in science and mathematics but no obvious career path. He spent time researching different options and considering what he might do next. He was now in his early 20s with a medical school education but no medical degree. During this period of uncertainty, Burry began to explore investing as a way to earn a living. He had always been interested in how markets worked. His analytical mind found the patterns in financial data compelling. He started reading investment books and studying financial statements. He discovered the works of Benjamin Graham, the legendary investor who developed value investing principles. Graham's approach appealed to Burry because it was fundamentally mathematical and logical. Burry began to teach himself about investing with the same intensity he had brought to medicine. He read everything he could find about stock analysis and valuation techniques. He studied the history of markets and learned about famous investors. He analyzed financial statements line by line, teaching himself accounting principles as he went. He started making small investments with his own money to learn how markets actually worked. He opened an account and began buying stocks that he believed were undervalued. He was starting from scratch, but his mind was perfectly adapted to this new challenge. In the late 90s, Burry was living in Houston and working in the medical field despite his eye condition. He was doing some administrative work and other tasks that did not require the level of vision that patient care demanded. He was earning enough money to live on, but he was not fulfilled by this work. His real passion was becoming the analysis of financial markets. He spent his evenings and weekends reading about investing and studying financial data. He was essentially retraining himself for a completely different career. Burry decided to pursue his passion for investing more formally. He went back to school to get an MBA degree with an emphasis on finance. He attended night school while working during the day. This was an extremely demanding schedule, but he was accustomed to hard work and intense focus. During his MBA studies, he deep dived into finance and accounting. He studied portfolio theory and investment analysis. He learned about different schools of thought regarding how to value companies and predict market movements. His analytical mind excelled in this environment where everything came down to numbers and logic. While pursuing his MBA, Burry began to think about starting his own investment fund. He had been successful at analyzing stocks and making profitable trades. He believed he had developed a system for finding undervalued companies. He wanted to apply this system on a larger scale. He was inspired by legendary investors like Warren Buffett and Charlie Munger. They had built fortunes through disciplined value investing. Burry believed he could follow a similar path. In 2001, Burry started his own investment partnership called Scion Capital in Dallas, Texas. He had saved enough money to start small. He opened the fund with about $1 million of his own money. He had a handful of outside investors as well. His investment approach was rooted in value investing principles but adapted to his own way of thinking. He believed in finding companies that were trading well below their intrinsic value. He would buy these companies when the market was not recognizing their true worth. Then he would hold them patiently until the market caught up. Scion Capital started out doing what Burry loved best, deeply analyzing stocks. He would spend weeks studying a single company before making an investment decision. He would read every quarterly report and every annual report going back years. He would analyze the competition and the industry dynamics. He would talk to customers and suppliers. He would understand every aspect of how the business worked. During the early 2000s, the stock market was recovering from the technology bubble burst of the previous years. Many investors had lost substantial sums during that crash. There was a general sense of caution in the market. Burry, however, was looking for opportunities that others might have missed. He was studying different sectors of the economy, trying to find undervalued investments. He looked at financial institutions and saw troubling trends in how mortgages were being handled. He began reading about mortgage-backed securities and subprime lending. This was not a popular area of focus at the time, but something about it caught his attention. By around 2004, Burry began to notice troubling patterns in the mortgage market. He saw that lending standards had become extremely loose. Banks were giving mortgages to people who could not afford to repay them. These subprime mortgages were being packaged into securities and sold to investors around the world. Wall Street had created a complex system where individual mortgages were bundled together and sliced into different risk categories. Investment grade ratings were assigned to even the riskiest portions of these securities. Burry found this arrangement fundamentally illogical and extremely risky. Burry began to study mortgage-backed securities with the same intensity he brought to any investment. He obtained prospectuses for these securities and read them carefully. He analyzed the underlying mortgages. He looked at borrower credit scores and down payments and loan-to-value ratios. The more he studied, the more disturbed he became. He saw loans being made to people with credit scores below 600. He saw loans where borrowers put down almost no money. He saw loans to people who had claimed they had no income. These were not loans that should have been made. Yet these mortgages were being packaged into securities rated as safer than treasury bonds. Burry realized that the mortgage market was constructed on a foundation of lies and false assumptions. The models used to rate these securities assumed that housing prices would never decline significantly. They assumed that unemployment would remain low. They assumed that borrowers would prioritize their mortgages over other debts. None of these assumptions were necessarily true. In fact, history suggested that all of these assumptions would eventually prove false. Burry could not understand how intelligent people at major financial institutions had accepted such flawed logic. Yet they had. The entire system was built on premises that made no sense. In 2005, Burry made a decision that many people thought was insane. He decided to bet that mortgage-backed securities would fail. To do this, he would use credit default swaps, a type of financial insurance. He would essentially make a wager that these securities would decline in value. Getting permission to make this bet proved difficult. Burry wanted to buy credit default swaps on mortgage-backed securities. But the banks that created these instruments did not want to sell them. From their perspective, selling insurance would be admitting that the securities might default. It would undermine confidence in the mortgage market. It would suggest that they did not believe in the quality of what they were selling. When Burry approached various Wall Street firms asking to buy credit default swaps, they were often dismissive. They told him that he was making a foolish bet. They implied that he did not understand the mortgage market. They suggested that he was wasting his time and his money. Eventually, Burry found dealers who were willing to take the other side of his bets. Some of the banks recognized that if Burry wanted to make this bet, there was money to be made. They did not necessarily agree that housing would decline. They simply saw an opportunity to collect fees and premiums. As Burry built his short position during 2005 and 2006, the housing market continued to boom. Housing prices climbed to record levels. Real estate agents talked about how housing was a sure bet. A guaranteed path to wealth, they said. People who had no business getting mortgages were being approved for loans. Stated income loans became common. Borrowers could simply claim how much they made without verification. Cash-out refinances were available for borrowers who wanted to borrow against the increased value of their homes. A culture of borrowing and speculation had taken hold in the housing market. People were treating houses as investment vehicles rather than as places to live. Burry watched this unfold with increasing alarm. He understood that this situation was unsustainable. Housing prices cannot climb forever. Eventually they would stop climbing and start declining. When that happened, all of the mortgages that had been made based on perpetually rising prices would come under stress. The experience of watching your investment thesis play out over years while losing money is psychologically taxing. Burry knew that he was right. He had done the analysis. He understood how the system worked. He knew that a collapse was coming. Yet month after month and quarter after quarter, the housing market kept climbing. His short positions kept losing money. His fund was underperforming the broader market, which was being driven higher by the housing bubble. Other investors in his fund were questioning whether they should continue to trust him. Some investors started to withdraw their money. The pressure was mounting from all directions. During this period, Burry communicated regularly with his investors through letters. He explained his thesis. He acknowledged that the positions were losing money in the short term. He asked investors to trust his analysis and to have patience. By late 2006, the first signs of trouble began to emerge. Housing prices started to slow their climb. Mortgage delinquencies began to rise. The financial press started to publish stories questioning whether housing was in a bubble. Burry's thesis was beginning to be vindicated. Yet the consensus on Wall Street remained that housing would not experience a significant decline. Most analysts still believed that a national housing price decline was impossible or at least extremely unlikely. The system had too much momentum to reverse. This belief in perpetual housing price appreciation was almost universal among financial professionals. In 2007, the housing market began to crack in earnest. Subprime lenders started to fail. Mortgage originations dried up. Housing prices began to decline in some markets. People who had taken out adjustable rate mortgages began to face dramatically higher payments as rates reset. Many borrowers could not afford the higher payments and started to default. Burry's credit default swap positions began to soar in value. The insurance policies he had bought when almost nobody else would, these suddenly became worth enormous amounts of money. In some cases, the positions increased in value by 10 times or more. His fund experienced returns that were almost unimaginable. A position that had cost $100,000 might now be worth $1 million. The positions that had caused his fund to underperform just months earlier were now generating extraordinary profits. The market had finally caught up to his analysis. By late 2007 and into 2008, the financial crisis deepened dramatically. Major financial institutions faced insolvency. Bear Stearns collapsed. Lehman Brothers filed for bankruptcy. AIG required a government bailout. Merrill Lynch was forced into a sale. The entire financial system appeared to be on the verge of total collapse. Credit markets froze. Scion Capital's returns in 2007 were extraordinary. The fund gained about 60% while the broader market experienced much more modest returns. In 2008, as the financial crisis intensified, Scion Capital continued to benefit from Burry's short positions. The fund's returns were among the best in the entire investment industry. Burry had not simply been right about the housing market. He had positioned his fund to profit from the collapse in a way that most investors had not. He had made bets when almost nobody else believed his thesis. Now those bets were paying off spectacularly. Yet despite the financial success, the psychological toll on Burry was significant. He had spent years being told he was wrong. He had endured criticism and skepticism from everyone around him. He had questioned himself despite his conviction in his analysis. The vindication when he was finally proven right should have been satisfying. Instead, Burry was deeply disturbed by what was happening to the financial system and to the country. People were losing their homes. Families were being devastated. The financial system was on the brink of collapse. Jobs were disappearing. The economic damage was spreading through the entire economy. The fact that he had profited from correctly predicting this collapse did not make him happy. After 2008, Burry faced questions about what to do next. He had made an enormous fortune by correctly predicting the housing collapse. His reputation as an investor was now established. He had turned $2 million of Scion Capital into around $500 million in assets under management. The industry was calling him a genius who had seen what nobody else could see. Major investment firms wanted to hire him. He was receiving offers to work at prestigious institutions. Instead, Burry began to withdraw from the investment industry. He had found the experience of managing money psychologically exhausting. The stress of defending his thesis for years while being wrong in the short term had worn on him. The realization that his correctness had led to devastating consequences for millions of people troubled him deeply. He was rich, but he was not happy. He closed Scion Capital in 2010. He told investors that he wanted to pursue personal interests. He did not want to manage other people's money anymore. The announcement surprised many people in the investment world. Why would someone voluntarily walk away from that kind of success? Burry's departure from money management was not impulsive. It was the result of years of reflection about what he really wanted from his life. He had pursued investing because he thought it would allow him to use his intellect and analytical abilities. He had succeeded beyond anything he could have imagined. He had made tens of millions of dollars. His thesis had been correct. He had proven that he could think more clearly about complex financial systems than almost anyone else. Yet he had found the entire experience unfulfilling. He had not found the purpose and meaning that he had been seeking. After leaving money management, Burry spent considerable time focusing on his personal life. He dealt with his eye condition, which continued to deteriorate. He married and started a family. He worked to build a normal life outside of the pressure and intensity of managing investment portfolios. He was not working in finance anymore, but his mind continued to analyze and observe the world around him. He maintained intellectual interests in various fields. He read widely and thought deeply about complex problems. He was looking for work that aligned with his values and his abilities. During the years after 2010, Burry made some investments in early cryptocurrency projects. He was intrigued by the technology and the potential of blockchain systems. He made relatively small investments in various crypto projects. He did this partly as an investor interested in identifying good opportunities. He was also intellectually curious about the technology. He was not an early cryptocurrency evangelist in the way that some other investors were. Rather, he took a cautious analytical approach, studying the technology. He looked at the potential risks and rewards. He made some profitable investments but also remained skeptical of aspects of the crypto industry. In more recent years, Burry has occasionally returned to making public statements about markets and investing. He has made predictions about various asset classes that have sometimes proven prescient. He has called attention to bubbles in different sectors. He has warned about dangers in various financial markets. Yet he has not returned to managing money professionally. He has maintained his status as an outsider and observer. He seems to have made a conscious choice to pursue a different kind of life. Burry's story reveals something important about genius and about excellence in modern finance. He had abilities that were extraordinary. His mind could perceive patterns that others could not see. His analytical powers were simply superior to those of most other people. He could have used these abilities to become one of the wealthiest and most powerful people in the financial world. Instead, he chose a different path. He chose to step away from the industry that had rewarded him so generously. This suggests that he valued something other than wealth and power. He valued his own well-being and his own sense of purpose. Michael Burry's greatest investment was not a particular stock or bond or mortgage-backed security. Rather, his greatest investment was in understanding how financial systems worked. He spent years studying and learning and analyzing. He developed frameworks for thinking about complex problems. He learned to trust his own analysis even when it conflicted with consensus opinion. He built the knowledge and the conviction necessary to make a contrarian bet when almost everyone else disagreed with him. When the moment of truth came, his preparation allowed him to position himself to benefit from the crisis that he had foreseen. What Burry demonstrated is that successful investing is not about predicting small movements in stock prices. It is about understanding fundamental reality. It is about seeing clearly how the world actually works. It is about having the intellectual discipline to follow logical analysis wherever it leads. Most people are not willing to think deeply about uncomfortable truths. Most people prefer to believe what the consensus believes. Burry was willing to think independently. He was willing to study difficult material. He was willing to make predictions that ran contrary to what everyone else believed. This combination of intellectual courage and analytical rigor created his success. The housing crisis of 2008 was one of the most significant financial events of the modern era. It destroyed tremendous wealth and disrupted millions of lives. It led to the Great Recession and years of economic difficulty. It exposed fundamental problems with how financial institutions operated. It revealed that the checks and balances meant to prevent systemic financial crises were not working. It showed that short-term incentives could lead to decisions that damaged the entire system. Michael Burry was not responsible for creating the crisis. He did not cause the housing bubble. But his foresight about what would happen gave him a unique view of events as they unfolded. Burry's story has become part of financial folklore. His life was documented in the book The Big Short, which was later made into a film. The film won major awards and brought his story to millions of people. The book told the story of the housing bubble and the investors who had bet against it. Burry was depicted as an eccentric genius who spent his time listening to music and thinking deeply about financial systems. The film portrayed his arrival at the financial world as the outsider who could see what insiders could not. This popular telling of his story helped to create the public image of Burry as a financial savant. Yet it also simplified and dramatized his actual experience in various ways. The popular attention brought by the film and the book made Burry famous. He became a symbol of the outsider investor who could think more clearly than the professionals. People interested in investing studied his methods and tried to replicate his success. Some became followers on social media waiting to see what investments he might be considering. Yet Burry was not comfortable with this attention. He found the celebrity that came from having his story told and retold to be intrusive and stressful. He had left money management partly to escape the pressure and the constant attention. Now that pressure was returning through a different channel. People wanted to know what he was thinking and what investments he might be considering. Michael Burry's experience of Asperger syndrome has often been highlighted in discussions of his success. Some people have suggested that his autism spectrum condition was essential to his ability to see what others could not. They argue that the same hyperfocus and attention to detail, the ability to perceive patterns that made social interaction difficult for him. also made him an exceptional financial analyst? This is a somewhat complicated question. Certainly Burry's particular way of thinking was well suited to financial analysis. His ability to absorb enormous amounts of information. His ability to see connections between disparate data points. These are characteristic of many people on the autism spectrum. Yet it would be reductive to credit his success entirely to his neurodivergence. He also brought discipline, curiosity, and intellectual courage to his work. What is clear is that Burry's path to success was very different from the typical trajectory for successful investors. Most people who become famous investors come from wealthy backgrounds. They come from prestigious schools or families in the financial industry. Burry came from none of these. He was an intellectual outsider who had to teach himself about finance and investing. He had to convince skeptical people to give him money to manage. He had to defend his thesis even when it was losing money. He had to make decisions that ran counter to the conventional wisdom of the entire financial industry. His success came not from following a standard playbook. It came from thinking independently and analyzing deeply. The lessons from Burry's experience are relevant to anyone trying to navigate complex systems. First, he demonstrated the value of studying deeply and understanding fundamental reality. He did not rely on conventional wisdom or what other people said was true. He read primary sources. He studied the data. He understood the underlying mechanisms of how the system worked. Second, he showed the importance of intellectual independence. He was willing to reach conclusions that differed from the consensus. He was willing to be alone in his beliefs if he was confident in his analysis. Third, he demonstrated that being right about something is not enough. Timing matters tremendously. Having patience matters. The ability to endure psychological stress while maintaining conviction matters. Burry's story also illustrates something troubling about modern financial systems. The fact that someone could correctly predict a major crisis that would devastate millions of people. The fact that the correct prediction was treated as exotic and unusual rather than as a warning. This suggests that something is broken. The financial system is supposed to allocate capital efficiently. It is supposed to regulate itself to prevent excessive risk-taking. The fact that Burry could be almost alone in recognizing the danger suggests that these mechanisms are not working properly. The fact that correctness about a major crisis went largely unheeded by the people who were in positions to prevent it. This speaks to deeper problems in how our financial institutions operate. In the years since the financial crisis, there has been considerable discussion about whether the financial system has been reformed. Regulations were implemented. Dodd-Frank legislation imposed new rules on banks. Capital requirements were increased. Stress tests were mandated. Yet many experts argue that these reforms did not go far enough. They argue that the fundamental incentives that led to excessive risk-taking. These incentives are still present. They argue that banks are still too large to fail. They still have incentives to take excessive risks knowing that they will be bailed out if things go wrong. Michael Burry has become something of a cultural figure in recent years. His story has inspired popular interest in investing and in financial analysis. Young people have become interested in studying financial markets. This partly came from the attention brought to Burry through the film and the book. Some of them have tried to emulate his approach of finding undervalued securities. Some have tried to copy his style of communicating through social media. Yet the copy is not the original. Burry's success came from his unique way of thinking and analyzing. It did not come from following a formula. Others who have tried to replicate his approach have generally not achieved the same results. What remains most striking about Burry's story is his willingness to walk away from tremendous success. After achieving everything that the financial world had to offer. After making hundreds of millions of dollars. After being proven right about one of the biggest financial events in modern history. He chose to step back. He chose to pursue a different kind of life. This suggests that he had learned something important from his experience of success. Perhaps he had learned that money and power and professional achievement do not necessarily lead to happiness or fulfillment. Perhaps he had learned that doing what you are good at is not the same as doing what matters to you. Perhaps he had learned that an outsider's view of the system is valuable partly because it maintains distance and independence. Burry's current relationship with the financial markets remains complex. He maintains his investment portfolio. He makes occasional public statements about markets and investments. He participates in social media discussions about financial topics. Yet he is not driven to build an empire or to accumulate more wealth or to achieve more success in conventional terms. He appears to have found a kind of peace with his unusual life. He is an intellectual outsider who was proven right about something tremendously important. He benefited financially from that correctness. But he also refused to be consumed by the process of accumulating more wealth and power. His story suggests that there are different ways to be successful. The way that our culture typically defines success may not be the way that leads to genuine fulfillment. Michael Burry's legacy will likely be remembered primarily for his correct prediction about the housing crisis. He will be remembered as the person who saw clearly what others could not see. He will be remembered as someone who had the courage to make a bet against consensus, even when that bet lost money in the short term. He will be remembered as someone whose intellectual capabilities allowed him to understand complex financial systems. He will be remembered as the subject of a popular film that introduced millions of people to the story of the financial crisis. Yet he may also be remembered for choosing a different path than what his talents and his wealth could have enabled. He may be remembered as someone who rejected the premise that professional success and financial wealth are the ultimate measures of a life well lived. The story of Michael Burry is ultimately a story about thinking clearly in a complex world. It is a story about being willing to be different. It is a story about reaching different conclusions than everyone else around you. It is a story about the long-term psychological costs of being right when everyone else is wrong. It is a story about the limited satisfactions of conventional success and achievement. It is a story about choosing to define your own path. It is a story about pursuing a life that feels meaningful to you. It is not about pursuing the path that society expects. It is a story that will continue to be told and discussed. It will continue to be reinterpreted as long as people are interested in investing and financial markets and human nature. Michael Burry remains an important and interesting figure in the landscape of modern finance, both for what he achieved and for the choices he made about how to live his life. Throughout his life and career, Burry has had to navigate the challenge of being someone who thinks and perceives the world differently from most other people. His autism spectrum diagnosis provides a framework for understanding some of these differences. His superior analytical abilities in certain domains. His difficulty with social interaction and with understanding social cues. His preference for concrete facts over abstract social conventions. His need for direct communication and his difficulty with irony and sarcasm. His tendency to hyperfocus on topics that interest him. These characteristics have made his life challenging in many ways. Yet they have also been the source of his greatest strengths and achievements. The question of whether Burry's success would have been possible if he were neurotypical is interesting to consider. His autism spectrum condition contributed to his ability to focus deeply on financial analysis. His different way of thinking helped him to question assumptions that neurotypical people might accept. His attention to detail and his ability to perceive patterns in data were valuable for an investor. Yet many neurotypical people have also succeeded as investors. Burry's success came from a combination of his particular abilities. His hard work, his discipline, his willingness to think independently. His extraordinary conviction in his analyses. The autism spectrum condition was part of the picture but not the whole picture. Burry's life raises important questions about how we think about disability and difference in modern society. He has a serious eye condition that has left him essentially blind. He is on the autism spectrum, which creates challenges with social interaction. Yet he has achieved extraordinary success in his chosen field. He has overcome physical limitations that would have prevented him from becoming a doctor. That was his original ambition. He has built a career that plays to his strengths rather than trying to fit into conventional paths that do not suit him. His success suggests that the path to achievement for people with disabilities or neurodevelopmentally differences may look different from conventional paths, but can still lead to great accomplishment. As Burry has moved into his 50s, he appears to have found a way to live that works for him. He maintains financial security from the wealth he accumulated as an investor. He pursues intellectual interests without the pressure of needing to generate returns for investors. He deals with his vision loss and has adapted to living with significant visual limitations. He maintains some public presence but has tried to set boundaries around how much attention and engagement he will give to being a public figure. He has built a private life that appears to bring him satisfaction. He seems to have found a way to be engaged with the world and with financial markets, without being consumed by the need for achievement and success in conventional terms. Michael Burry's journey from a medical school student with progressive vision loss to one of the most successful investors of the early 21st century represents an unusual path to fulfillment. Then to a man who chose to step away from wealth accumulation. His story teaches lessons about deep thinking and independent analysis. His story teaches lessons about the importance of being willing to reach conclusions that contradict consensus. His story teaches lessons about the long-term psychological and spiritual costs of certain kinds of professional achievement. His story teaches lessons about what truly matters in life beyond wealth and status. His story teaches lessons about how people who think and perceive the world differently, how they can contribute uniquely valuable insights and achievements. The housing crisis of 2008 will likely be remembered as one of the defining financial events of the modern era. It exposed fundamental problems with how financial institutions operated. It revealed that the checks and balances meant to prevent systemic financial crises were not working. It caused tremendous economic damage and suffering. It changed how people thought about real estate and about financial risk. And it made Michael Burry famous as the person who had predicted it, who had positioned himself to profit from it. Yet the crisis also exposed something troubling about how financial systems work. Despite Burry's clear analysis of the dangers, despite his attempts to warn people, the crisis occurred anyway. The system continued on its path of excessive risk-taking until it broke. This suggests that individual insight and correct analysis are not always sufficient to prevent systemic problems. Burry's experience highlights both the value of independent thinking and analysis, and also the limits of what individual analysis can accomplish. Even if you are correct about a danger, even if you understand how a system works, even if you can see clearly that a crash is coming, you cannot necessarily prevent that crash. You can position yourself to benefit from it, but you cannot necessarily prevent it. This is a humbling realization for someone who has spent their career thinking carefully and deeply about complex systems. It suggests that the problems with financial systems are not simply problems of analysis or understanding. They are problems of incentive structures and institutional design and human psychology. Solving these problems would require changes at a systemic level that go beyond what individual insight can accomplish. This realization may be part of what led Burry to step back from money management. He had proven that his analysis was excellent. He had positioned himself correctly. He had made an enormous fortune. Yet none of this had prevented the crisis that had caused so much damage to so many people. In a certain sense, his success came at the cost of tremendous suffering for millions of people who lost their homes, who lost their jobs and their savings. The moral weight of this may be something that Burry has had to grapple with. His profits came from betting against a market that crashed and hurt millions of people. This is not a comfortable position to be in from a moral perspective, even though the financial logic of his investment thesis is impeccable. Michael Burry's legacy will ultimately be defined by multiple things. It will be defined by his correct prediction about the housing market and the financial crisis. It will be defined by his analytical methods and his willingness to think independently. It will be defined by his decision to step away from money management despite the opportunity to continue accumulating wealth. It will be defined by the way he has navigated his physical challenges, including his progressive vision loss. It will be defined by how he has adapted and overcome these challenges. It will be defined by his ongoing engagement with financial markets. It will be defined by his willingness to share his analysis even though it is uncomfortable for him to be a public figure. It will be defined by his refusal to simply accept the conventional path to success. It will be defined by his insistence on defining success on his own terms. For young people interested in investing and finance, Burry's story offers several important lessons. First, independent analysis and deep research matter. Taking the time to understand something thoroughly gives you an advantage. Second, being willing to think differently than the consensus can be valuable. But it requires conviction and psychological strength. Third, having the financial resources to weather short-term losses while waiting for your thesis to play out is important. Not everyone has access to these resources, which means that some of Burry's advantages were circumstantial. Fourth, being right about something is not the same as being right about when it will happen. Timing matters tremendously in investing. Fifth, accumulating wealth and achieving conventional success do not necessarily lead to fulfillment or happiness. Finding work that feels meaningful and aligning your life with your values matters. The rise of artificial intelligence and machine learning in financial markets represents another significant technological change. This change has occurred since Burry made his famous call on the housing market. Algorithms now analyze vast amounts of data and make predictions about market movements. Machine learning systems can identify patterns that humans cannot see. These technologies may make it harder for individual investors to find mispricings and inefficiencies in markets. Yet they may also create new kinds of mispricings as algorithms and machine learning systems systematically misinterpret data. They may create new kinds of mispricings as they all move in the same direction, creating cascading effects. The relationship between human intelligence and machine intelligence in financial markets is still being worked out. Burry's approach of deep human analysis combined with skepticism toward consensus opinions may remain valuable, even as these new technologies emerge. As Burry has aged and has accumulated more experience, he has also developed a longer time perspective. He has developed a longer time perspective on financial markets and economic cycles. He has lived through multiple market crashes and booms. He has seen how the financial system behaves under stress. He has observed how policies respond to crises. He has gained a historical perspective that is valuable for understanding how markets work. This is valuable for understanding how markets work over long periods of time. This long-term perspective may be one of his most valuable contributions to the discussion about financial markets. Short-term traders focus on daily and weekly price movements. Even medium-term investors focus on quarterly or annual returns. Burry's perspective extends over decades. He thinks about long-term trends and long-term consequences of current policy decisions. The question of whether the world is heading toward another financial crisis similar to the 2008 financial crisis, or whether crises will take different forms, is something that people continue to debate. Burry's recent warnings about various bubbles and overvaluation suggest that he believes another significant correction or crisis is likely. At some point, the exact timing and the exact form that such a crisis would take remains uncertain. His warnings have been prescient at times, but also have sometimes been early or not fully accurate in their predictions. This highlights the fundamental difficulty of predicting financial crises. Even the most brilliant analysts cannot predict them with perfect accuracy. What they can do is identify trends and risks that suggest that the system is becoming more fragile. What they can do is identify trends and risks that suggest that the system is becoming more vulnerable to shock. Burry's story is ultimately a human story about someone with unusual abilities and unusual challenges, who found a way to apply his abilities in a domain where they could have tremendous impact. He started as an outsider to the financial world. He taught himself about investing. He developed a distinctive analytical approach. He made a call that everyone else thought was crazy. He was proven right about something tremendously important. He made an enormous fortune. He then chose to step away from that path and to pursue a different kind of life. His story has been told and retold through books and films and articles. His name has become associated with the housing crisis and with independent thinking about financial markets. Yet the person himself remains relatively private. He prefers to avoid the attention and the public profile that his fame has created. As this account of Michael Burry's life and career continues, it is worth recognizing that his story is still ongoing. He continues to live and work and think and invest. He continues to make predictions about financial markets and economic trends. He continues to navigate the challenges of being a public figure despite his preference for privacy. He continues to deal with his progressive vision loss and to adapt to the limitations it creates. He continues to pursue intellectual interests and to apply his analytical abilities to various domains. His story has not ended but rather continues to unfold in ways that cannot be fully predicted or understood yet. What will ultimately matter is not just how he made his money. What will ultimately matter is not just how he correctly predicted the housing crisis, but how he chose to live his life after achieving that success and that recognition. After closing Scion Capital in 2010, Burry spent several years working through what his next chapter would look like. He had the financial security to never work again if he did not want to. He had proven his intellectual capabilities to himself and to the world. He no longer had anything to prove in the traditional sense. Yet he was not someone who could simply retire and do nothing. His mind needed engagement. His intellectual curiosity needed outlets. He began to explore various interests and possibilities. He read extensively. He thought about different domains where his analytical skills might be applied. He was searching for work that would feel meaningful without the stress and pressure that managing money had brought. Burry's eye condition continued to deteriorate throughout this period. His vision loss progressed gradually but steadily. By the early 2000s, he was legally blind in one eye. He had only limited vision in the other. He had adapted to this throughout his career as an investor. He had used magnification technology and by working with assistants. These assistants could help him access information he needed. As his vision got worse, he had to adapt further. He explored new technologies and tools that could help him continue to read. He explored new tools that could help him engage with information despite his visual limitations. He worked with specialists on vision rehabilitation. He was learning how to navigate the world with significantly diminished sight. The challenge of managing progressive vision loss is profound in ways that sighted people often do not fully appreciate. Many aspects of daily life depend on vision that most people take for granted. Reading requires sight. Driving requires sight. Recognizing people requires sight. Even simple tasks like walking around and understanding your spatial environment depend partly on vision. Burry had managed to work around these limitations while building his investment career. He had used technology and workarounds and help from other people. But as his vision deteriorated further, these workarounds became less effective. He had to develop new strategies and new ways of engaging with the world. Despite his vision challenges, Burry continued to maintain his intellectual engagement with financial markets. He continued to maintain his intellectual engagement with the world more broadly. He read books and articles using assistive technology. He listened to podcasts and lectures. He participated in online discussions about investing and finance. He made investments for his own account. He kept track of financial markets and economic developments. He was not withdrawing from intellectual engagement. Rather, he was finding new ways to continue that engagement given his physical limitations. His mind remained as active and curious as ever. His body and his eyes were the things that were limiting him. In the middle of the 2000s decade, Burry became interested in early cryptocurrency projects. He started researching blockchain technology and digital currencies. He was intrigued by the underlying technology. He was intrigued by the potential applications of decentralized systems. He made some investments in various cryptocurrency projects. He did not become a crypto evangelist or a true believer in the way that some other investors did. Rather, he approached it with the same analytical skepticism that he brought to other investments. He tried to understand what was valuable about the technology. He tried to understand what was hype. He made some profitable investments but also remained critical of aspects of the crypto industry. Burry's involvement with cryptocurrency gave him another outlet for his analytical skills. He could research new technologies. He could study the economics of different crypto projects. He could make contrarian bets on assets that most traditional investors ignored. He could engage with a community of people who were thinking about new ways to organize financial systems. In some ways, his interest in cryptocurrency reflected his ongoing desire to find inefficiencies and mispricings in financial markets. In other ways, it reflected his intellectual interest in novel technologies and new possibilities. Yet he approached it differently than some other investors approached it. He maintained skepticism about elements that seemed dubious to him. By the middle of the 2010s decade, Burry was becoming an occasional public figure in financial markets. The Big Short film had been released in 2015. This had brought significant attention to his story. People interested in investing sought out his views. Media outlets wanted to interview him. He became a somewhat visible presence on social media. He would occasionally share his thoughts about markets and investments. He was not seeking this attention and did not particularly enjoy it. But he did participate in it to some degree. He was selective about what he shared and how he shared it. He tried to maintain some privacy while also engaging with the broader conversation about investing and markets. One area where Burry has been vocal in recent years is in warning about various bubbles. He has warned about overvaluations that he perceived in financial markets. He has suggested that certain asset classes were overpriced. He has warned about the dangers of excessive leverage and debt in the financial system. He has expressed concern about the concentration of wealth and the growing inequality in society. He has made predictions about potential market downturns or corrections. Some of these warnings have been heeded. Others have been dismissed as the dire predictions of someone who is overly pessimistic. It is difficult to assess whether Burry has been correct in these more recent predictions. It is difficult to assess whether he has simply been consistently bearish. The challenge with making repeated warnings about dangers and bubbles is that you are eventually proven right. But also proven wrong many times. If you are constantly predicting that the market will crash, eventually a crash will come. You will be correct. But in the meantime, you will have been wrong many times. This creates a credibility challenge. People start to discount your warnings because you have been wrong so often in the past. The boy who cried wolf phenomenon applies to market predictions. It applies to other areas of life as well. Burry's track record on housing was extraordinary. But it does not mean that he will be correct about every market prediction he makes going forward. Burry's predictions in recent years about various bubbles and overvaluations have been mixed in their accuracy. Some of his concerns have proven prescient while others have not come to pass. He has expressed concern about tech stock valuations. He has expressed concern about companies that are valued at very high multiples relative to their earnings. He has warned about the risks in meme stocks and cryptocurrencies. He has warned about where retail investors pile in following social media hype. He has expressed concern about the long-term consequences of massive government stimulus. He has expressed concern about money printing. He has warned about the risks of excessive leverage and margin debt. Some of these concerns have proven more accurate than others. It is difficult to invest successfully if your views are consistently several years ahead of market sentiment. In 2020, when the COVID-19 pandemic struck and the world went into lockdown, Burry initially made predictions that proved incorrect. He suggested that stock markets would experience a significant decline. The economy was shutting down. Instead, markets declined sharply initially but then recovered quickly. Markets continued to climb to new highs. Governments and central banks implemented unprecedented levels of stimulus. The money supply expanded at a rate not seen since the financial crisis. Stock valuations climbed to levels not seen since the dot-com bubble. Burry watched these developments with growing concern. He made various public statements expressing worry about the consequences of monetary expansion. He expressed worry about the risks of bubbles in various asset classes. By 2021, Burry was expressing increasing concern about meme stocks. He was expressing increasing concern about retail investor enthusiasm for stocks like GameStop and AMC. He warned about the dangers of retail investors piling into stocks based on social media hype, without understanding the underlying businesses. He expressed concern about margin debt and leverage in the system. He suggested that a significant market correction was coming. He predicted that cryptocurrency prices would crash. He warned about the risks of various bubbles inflating in different asset classes. As 2022 began, some of his warnings started to come true. Tech stocks and cryptocurrencies experienced significant declines. Markets became more volatile. His warnings that seemed overly pessimistic in 2021 started to look more prescient. The experience of being wrong and then being proven right again has interesting parallels to Burry's experience during the housing crisis. Then, he had been right in his ultimate thesis but had been wrong in his timing. He had experienced significant stress while waiting for the market to catch up to his analysis. Now, he appeared to be experiencing something similar. His concerns about overvaluation and bubbles were eventually validated. But there was a significant lag between when he first expressed concern and when the market actually experienced the downturn he had predicted. This pattern suggests something about the nature of contrarian investing. This pattern suggests something about how markets work. Burry's public profile has continued to grow in recent years. This happened even though he has tried to maintain his privacy. He has tried to keep a low public profile. His Twitter account has attracted hundreds of thousands of followers. These followers are interested in his views about markets and investments. His occasional posts about financial topics generate significant engagement and discussion. Media outlets continue to seek him out for interviews and commentary. Young people interested in investing study his approach and his investment philosophy. His story continues to be told and retold in books and documentaries and films. He has become something of a cultural figure beyond just financial circles. This celebrity status has been uncomfortable for Burry in ways that are not difficult to understand. He is someone who is on the autism spectrum. He naturally prefers to work alone and to avoid social interaction. The constant attention and the pressure to comment on various market developments. The pressure to comment on various financial topics is stressful for someone with his personality. It is stressful for someone with his neurodevelopmentally profile. He has expressed frustration with the pressure to have opinions about every market development. He has said that he wants to be left alone to focus on his research and his thinking. Yet the public attention continues regardless of his preference for privacy. He has become famous despite not wanting to be famous. In recent years, Burry has also become interested in environmental and agricultural issues. He has made some investments in farmland and in agricultural businesses. He has expressed interest in food security and in sustainable agriculture. He has suggested that there may be significant opportunities in these areas. These are areas as the world faces challenges related to climate change and resource scarcity. This interest in agriculture reflects his broader intellectual curiosity. It reflects his willingness to think about long-term challenges facing society. It also represents an area where he can apply his analytical skills. He can apply these skills without being as much in the public eye. He avoids being as much in the public eye as he was with his market predictions. He avoids being as much in the public eye with his commentary on financial bubbles. Burry's life in recent years has been characterized by relative quietness. This is compared to the intensity of the housing crisis years. He has stepped back from being at the center of financial markets. He has avoided taking on new large pools of investor capital. He has focused on his own investments and on his personal interests. He has dealt with his progressive eye condition. He has adapted to managing daily life with significantly limited vision. He has spent time with his family. He has pursued intellectual interests in various domains. He has maintained some public presence but has tried to limit it. He has tried to set boundaries around his private life. This quieter approach to life seems to suit him better than the intensity of managing large amounts of money. The question of what defines a successful life and a meaningful career is something that Burry's story raises in interesting ways. He achieved tremendous financial success by conventional standards. He made hundreds of millions of dollars. He was proven correct about something tremendously important. He became famous. Yet he walked away from the opportunity to continue accumulating wealth and power. He chose to step back and pursue a different kind of life. This suggests that he had come to understand something important. Financial success and professional achievement do not necessarily lead to personal fulfillment. What mattered more to him was finding work that felt meaningful. Having the freedom to live according to his own values mattered more. One interesting aspect of Burry's later years is how he has tried to use his platform. He has tried to use his platform to highlight issues that he cares about beyond just financial markets. He has made public statements about issues like wealth inequality. He has made public statements about the concentration of power in financial institutions. He has expressed concern about the long-term consequences of monetary policy decisions. He has expressed concern about decisions made by central banks. He has commented on social and political issues that concern him. He has used his voice and his visibility to try to raise awareness about problems. He has tried to raise awareness about problems that he perceives in financial systems and in society. This represents a different kind of engagement with the world than simply making money through investments. Burry's relationship with social media has evolved over the years. In the early years after The Big Short film brought him fame, he was relatively cautious. He was cautious about engaging with social media. He was concerned about how he might be misinterpreted or misquoted. He worried about the pressure to constantly comment on market developments. Over time, he became somewhat more active on platforms like Twitter. He has used social media to share his thoughts about markets and investments. He has engaged with people who are interested in his views. He has also experienced the downsides of social media, including harassment and criticism. He has had to learn how to navigate the challenges of being a public figure. He has had to learn how to navigate the challenges of the age of social media. The emergence of social media has changed the landscape for public figures. It has changed the landscape for investors who want to share their views. In earlier eras, investors could work quietly without constant scrutiny from the public. Now, anyone who has a social media presence is subject to constant criticism and commentary. Every statement is analyzed and debated. Every prediction is remembered and thrown back at the person. Predictions are thrown back if they do not come to pass. This creates a different kind of pressure than the traditional media environment created. Burry has had to adapt to this new landscape. He has had to adapt while maintaining his own values. He has had to maintain boundaries around what he wants to share. He has had to maintain boundaries around how much attention he wants. Looking at Burry's career trajectory from start to finish reveals several interesting patterns. He started as an outsider to the financial world. He was someone who had to teach himself about investing. He had to convince skeptical people to give him capital to manage. He succeeded through deep research and contrarian thinking. He made a call that everyone else thought was crazy. He was proven right and made an enormous fortune. Then he stepped away from the industry and pursued a different kind of life. Then he re-emerged as a public figure. He has since been making various predictions about markets. This trajectory suggests someone who is driven by intellectual curiosity. He is driven by the challenge of understanding complex systems. He is not driven by the pursuit of wealth and power for their own sake. Burry's story is also a story about the importance of thinking independently. It is a story about being willing to reach conclusions that contradict the consensus. Everyone else in the financial industry believed that housing prices would not decline significantly. Everyone else thought that mortgage-backed securities were safe investments. Everyone else trusted the rating agencies and the models used to price these securities. Burry looked at the data and reached a different conclusion. He was willing to act on that conclusion even when it made him unpopular. Even when his positions lost money in the short term. This willingness to think independently is something that applies to far more than just financial markets. The fact that Burry's analysis was correct but that his warnings were not heeded raises important questions. These questions are about how we as a society process information and make decisions. Burry was not the only person warning about dangers in the mortgage market. There were other voices saying similar things. Yet the financial system continued on its path of excessive risk-taking and overvaluation. Why do we not listen to warnings about obvious dangers until it is too late? What would it take for institutions and individuals to take these warnings seriously? What would it take to take them seriously before disasters occur rather than after? These questions are relevant to many different contexts beyond just financial markets. Burry's experience also highlights the challenges of being right too early. It highlights the challenges of being right in a way that is not popular. If you make a correct prediction years before it comes to pass, you may be seen as a crank or a doomsayer. You may lose money and reputation before you are eventually proven right. The psychological toll of this can be significant. You have to maintain conviction in your analysis despite widespread disagreement. You have to have the financial resources to weather the losses. These losses come from being right too early. Not everyone has the constitution or the resources to do this. Burry had both, and that made it possible for him to follow through. It made it possible for him to follow through on his thesis despite years of being wrong in the short term. The lessons from Burry's life are relevant not just to investing but to thinking and decision-making more broadly. First, deep research and careful analysis matter. Taking the time to really understand something gives you an advantage. Second, being willing to think differently than the consensus can be valuable. Third, having conviction in your analysis even when others disagree is important. Fourth, being willing to wait for the market or the world to catch up to your understanding requires patience. It requires psychological strength. Fifth, recognizing that accumulating more wealth and more power does not necessarily lead to fulfillment or happiness is important. Sixth, maintaining your values and your boundaries even when you have the opportunity to accumulate more wealth and power is important. These are core lessons from Burry's life and career. Michael Burry's life and career have been unconventional in many ways. He came to investing through a non-traditional path. He succeeded through deep analysis and contrarian thinking. He made an extraordinarily successful bet against the financial system. He then walked away from the opportunity to continue building his wealth and his power. He has lived with significant visual limitations and has adapted and overcome those limitations. He has dealt with the challenges of being neurodivergent in a world that is often not built for neurodivergent people. He has achieved great financial success and has then chosen to step back from that success. His story does not fit the typical narrative of what success looks like. His story does not fit the typical narrative of what a successful person should want. In the end, Burry's greatest achievement may not be his correct prediction about the housing market. It may not be his correct prediction about the housing market and the financial crisis. It may be his willingness to define success on his own terms. It may be his willingness to pursue a life that is meaningful to him, rather than pursuing the conventional path of accumulating ever more wealth and power. He had the opportunity to become one of the most powerful and influential figures in global finance. He chose instead to step back and to pursue a quieter life. He valued his own well-being and his intellectual engagement over status and power. He valued his freedom and his privacy over public recognition. These choices reveal something important about what truly matters to him. These choices reveal something important about what he believes contributes to a good life. Michael Burry remains an interesting and important figure in the world of investing and finance. His story continues to be studied and discussed by people interested in investing and financial markets. His analysis of the housing market continues to be cited as an example of clear thinking. It continues to be cited as an example of thinking about complex systems. His willingness to think independently continues to inspire people. It continues to inspire people who want to pursue their own analysis, rather than following the consensus. His decision to step away from money management continues to raise questions about what success means. It continues to raise questions about what constitutes a life well lived. His ongoing commentary about financial markets continues to spark discussion. It continues to spark discussion about bubbles and overvaluation. It continues to spark discussion about the long-term health of financial systems. He remains relevant to current debates about finance and investing and society. He remains relevant even as he tries to maintain his privacy. He remains relevant even as he tries to focus on his own intellectual pursuits. The pandemic years of 2020 and 2021 brought significant changes to financial markets. These years brought significant changes to the broader economy. Unprecedented levels of government stimulus and central bank money printing led to rapid asset price inflation. Inflation occurred across multiple categories. Tech stocks soared to levels not seen since the dot-com bubble. Cryptocurrency prices climbed to all-time highs. Meme stocks became popular among retail investors. Valuations in many asset classes reached levels that appeared to be disconnected from fundamental value. Burry watched these developments with alarm. He made public statements expressing concern about various bubbles that he perceived forming. He warned about the consequences of excessive monetary expansion. He predicted that corrections and crashes would come. Some of Burry's warnings in the pandemic period have proven accurate while others have been early. Tech stocks and cryptocurrencies did experience significant declines in 2022. Markets did become more volatile. His concerns about overvaluation and bubbles appear to have had merit. Yet the financial system did not completely collapse as some of his most dire predictions suggested might happen. Asset prices have stabilized at new levels. The economy has continued to function. The feared deflationary spiral or debt crisis has not materialized. This suggests that even with his extraordinary analytical abilities, predicting the exact timing and magnitude of financial events remains extremely difficult. Burry's experience in recent years reinforces an important lesson about financial markets. This lesson is about prediction in general. Even if you are correct about the direction of long-term trends, being wrong about timing can be extremely costly. If you predict a crash that does not occur for several years, you may lose enormous amounts of money. You may lose money while waiting for the crash to happen. Your investors may abandon you before your thesis comes true. You may lose your conviction and exit your positions before the crash occurs. Being right about the long-term direction is not the same as being right about when the direction will change. This timing challenge is one of the fundamental difficulties of investing. This timing challenge is one of the fundamental difficulties of prediction in general. Throughout his life and career, Burry has had to navigate the challenge of being someone who thinks and perceives the world differently from most other people. His autism spectrum diagnosis provides a framework for understanding some of these differences. His superior analytical abilities in certain domains. His difficulty with social interaction and with understanding social cues. His preference for concrete facts over abstract social conventions. His need for direct communication and his difficulty with irony and sarcasm. His tendency to hyperfocus on topics that interest him. His difficulty with change and transition. These characteristics have made his life challenging in many ways. Yet they have also been the source of his greatest strengths and achievements. The question of whether Burry's success would have been possible if he were neurotypical is interesting to consider. His autism spectrum condition contributed to his ability to focus deeply on financial analysis. His different way of thinking helped him to question assumptions that neurotypical people might accept. His attention to detail and his ability to perceive patterns in data were valuable for an investor. Yet many neurotypical people have also succeeded as investors. Burry's success came from a combination of his particular abilities. His hard work, his discipline, his willingness to think independently. His extraordinary conviction in his analyses. The autism spectrum condition was part of the picture but not the whole picture. Burry's life raises important questions about how we think about disability and difference in modern society. He has a serious eye condition that has left him essentially blind. He is on the autism spectrum, which creates challenges with social interaction. Yet he has achieved extraordinary success in his chosen field. He has overcome physical limitations that would have prevented him from becoming a doctor. That was his original ambition. He has built a career that plays to his strengths, rather than trying to fit into conventional paths that do not suit him. His success suggests that the path to achievement for people with disabilities or neurodevelopmentally differences may look different. These paths may look different from conventional paths but can still lead to great accomplishment. As Burry moved into his mid-50s, he appeared to have found a way to live that works for him. He maintained financial security from the wealth he accumulated as an investor. He pursued intellectual interests without the pressure of needing to generate returns for investors. He dealt with his vision loss and adapted to living with significant visual limitations. He maintained some public presence but set boundaries around his engagement. He set boundaries around how much attention he would give to being a public figure. He built a private life that appeared to bring him satisfaction. He seemed to have found a way to be engaged with the world and with financial markets, without being consumed by the need for achievement and success in conventional terms. Michael Burry's journey represents an unusual path to fulfillment. From a medical school student with progressive vision loss, to one of the most successful investors of the early 21st century, to a man who chose to step away from wealth accumulation. This represents an unusual path to pursue a quieter life. His story teaches lessons about deep thinking and independent analysis. His story teaches lessons about the importance of being willing to reach conclusions that contradict consensus. His story teaches lessons about the long-term psychological and spiritual costs. It teaches about the costs of certain kinds of professional achievement. His story teaches lessons about what truly matters in life beyond wealth and status. His story teaches lessons about how people who think and perceive the world differently, how they can contribute uniquely valuable insights and achievements. His story will continue to be studied and discussed for years to come. Young people interested in investing and finance will continue to learn from his example. His analysis of the housing market will continue to be cited as an example. It will continue to be cited as an example of clear thinking about complex systems. His willingness to think independently will continue to inspire others. His choice to step away from conventional success will continue to raise questions about what truly matters in life. Michael Burry's legacy extends far beyond his financial success or his correct prediction about the housing crisis. His legacy includes his willingness to think independently. His legacy includes his refusal to accept conventional definitions of success. His legacy includes his decision to prioritize his own well-being and sense of purpose over continued accumulation of wealth and power. His story reminds us that there are different paths to fulfillment. His story reminds us that conventional success does not always lead to genuine happiness. His story reminds us of the value of intellectual independence. His story reminds us of the value of thinking carefully about complex systems. His story reminds us of the importance of maintaining your values and boundaries, even when you have the opportunity to pursue more wealth and power.